Holy flippity flip flop flappin' smokes, everyone. A major bank is on verge of collapse, and guess what? If this bank goes down, all the deposits will be bailed in, aka they will be taken. I've been putting out urgent warnings this month that the banks are in big trouble and we're at the risk of a financial crisis like 2008, but much worse this time because the bubble is much bigger. I've been warning that your money is in danger and it is not safe in the banks anymore. With the Dodd-Frank Wall Street Reform and Consumer Act, banks, when they go down, when they start to fail, they can legally bail in your deposits and give you worthless shares. While people with currencies around the world crashing like the Japanese yen, Chinese yuan, the British pound, Australian dollar, with the bond market nearly collapsing in the UK, if that wasn't warning enough for you, well, we just got another huge critical warning. So what big banking institution is in trouble? Well, everyone, that's exactly what we're going to go over in today's video. So let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, so first things first, this is something we're going to get into in today's video, everyone. The Fed is breaking things. Here's what has Wall Street on edge as risks rise around the world. So what normally happens when central banks start lifting interest rates and start quantitative tightening, that's when they start selling assets on their balance sheet like bonds and mortgage-backed securities. Normally this exposes weakness in the financial system and exposes the fragility in the financial system. And because the banks have relied so much on cheap debt and a lot of zombie corporations and free money being handed out, as soon as that's taken away, we see how weak these big, huge institutions really are. And what I think is going to happen over the next few months, we're going to see some of these institutions that we thought were too big to fail, literally start to fail, just like what we've seen over the past few months in China with Evergrande. Because look at this, everyone, this is a huge developing story right now. Credit Suisse shares tanked 10% on restructuring and capital concerns. This is huge, everyone, and a week ago I put out a video saying we only have 7 days left, and I said in that video I think during the following week we're going to see a beginning of a Lehman-like moment. And that's exactly what happened with what happened in the UK, with what happened with the pound crashing, with the bond market crashing in the UK, and with the currencies collapsing around the world. And now we just got this news literally 7 days later after I posted that video, the Credit Suisse could be on the verge of going under, especially in the US. Spread of the bank's credit default swaps, CDS, which provide investors with protection against financial risk such as default, rose sharply Friday. They followed reports that the Swiss lender is looking to raise capital, citing a memo from its chief executive. I don't know about you people, but I'm starting to see alarm bells go off. And this is starting to look a lot like 2008 with these credit default swaps, with a lot of these insurance products which were meant to protect these financial institutions from huge amounts of defaults and bankruptcies. Well, again, like we've seen when AIG went down in 2008, the insurer for all these junk mortgages, they went bust. I think we're going to see some of the insurers for these financial institutions today go bust. The stock is down about 60% year to date. I trust that you are not confusing our day-to-day stock price performance with strong capital base and liquidity positions of the bank, the CEO said in a separate staff memo obtained by CNBC. Well, of course, the CEO is going to say, look guys, there's nothing to panic. Even though our stock price has crashed 60%, there's nothing to worry about. Well, people, what you have to do is you have to follow the money. And the money's telling us otherwise. Financial Times said the executive denied reports that the Swiss lender had formally approached its investors about possibly raising more capital and insisted Credit Suisse was trying to avoid such a move with its share price at record lows and high borrowing costs due to rating downgrades. Wow, people, this is huge, and let me put this simply for you. What we've seen over the past 10 years is a lot of companies being able to raise very cheap capital, and what they've been able to do is use this cheap credit to buy back their stock. Because, for example, if they could get credit at 1 or 2% interest rates as a primary dealer from the Federal Reserve, and then use that to buy back their stock and get an average return of 7 to 8%, it makes sense. But with borrowing costs going up very, very high, and especially for these zombie corporations that have their credit downgraded, well, they're not going to be able to get this cheap credit anymore. And someone left this in the comment section in my video yesterday, and I thought this was a great point. And if they try to issue more shares right now when their share price is at record lows, this is going to dilute shares more and more, and it's going to make their stock price fall lower and lower and put them at more and more risk of collapsing. The bank told Reuters that it's in the process of a strategy review that includes potential divestitures and asset sales. So could this be one reason why we're starting to see the stock market crashing right now? Because a lot of these companies that are in big trouble are selling assets, like Credit Suisse is going to have to do. And I think this could lead to more selling as we start to see interest rates go higher and higher, and then that is going to lead to even some of the healthy institutions be in some real trouble with a huge amounts of debt on these public companies' balance sheets. Now listen to this, everyone. This is huge. Credit Suisse has also been in talks with investors to raise capital with various scenarios in mind, Reuters said, citing people familiar with the matter as saying it includes a chance that the bank may largely exit the US market. So this is crazy. Imagine all the people banking with Credit Suisse in the US. Well, they may leave the US altogether, and then these customers are going to have to find a new bank. And what could even be worse, we just hope this doesn't happen, but what if their institution fails in the US? So if you have any money with Credit Suisse in the US, not financial advice, but me personally, I'd be running to the bank right now and withdrawing every last cent. And of course, they try to tell us, look, there's nothing to worry about. There's not going to be any collapse. There's no issue here. So the banks are strong, just like they said Lehman Brothers wouldn't collapse. We understand the nature of the concerns, but the current situation is night and day from 2007, as the balance sheets are fundamentally different in terms of capital and liquidity. The report said, referring to the financial crisis that unraveled in 2007, we believe the US bank stocks are very attractive here, the report said. Of course, they're going to say that. Go in and buy these stocks that are only going to crash low and low, everyone, so they can sell to you, the sucker. So, okay, we know Credit Suisse is in big trouble. But there's a saying, it's better the devil you know than the devil you don't know. We know Credit Suisse is in trouble, but what happens during these financial crises is there's always something in the plumbing or always something beneath the surface that we don't even know about yet. The Fed is breaking things, said Benjamin Dunn, formerly a chief risk officer at a hedge fund who now runs consultancy Alpha Theory Advisors. There's really nothing historical you can point to for what's going on in the market today. We're seeing multiple standard deviations, moves in things like the Swedish krona and in treasuries, in oil, silver, like every other day. These aren't healthy moves. He's exactly right. Again, people, we're seeing every single market in the financial system, in the banking sector, in big trouble. Like I said, the stock market's down, cryptocurrency's down, the bond market's down, gold and silver is down, commodities are now starting to crash. And like I've been warning about, the surging US dollar is going to cause a foreign debt crisis, because that means these other countries that are having their currency fall, they're going to have to print more of that currency to pay back their debt that is denominated in US dollars. And they're also going to have to sell US treasuries to get dollars. And that's going to mean interest rates on the US treasuries are going to go up, which is going to lead to higher funding costs for these corporations. Such US dollar strength has historically led to some kind of financial or economic crisis. Morgan Stanley chief equity strategist Michael Wilson said on Monday in a note. Past peaks in the dollar have coincided with the Mexican debt crisis of the early 1990s, the US tech stock bubble of the late 90s, the housing mania that preceded the 2008 financial crisis, and the 2012 sovereign debt crisis, according to the investment bank. Did you hear that, everyone? Every time the dollar has strengthened this much, we're seeing some kind of foreign debt crisis overseas. And what's even more worrying is a lot of these countries, we don't know how bad their financial institutions really are, because they're not as transparent as the US with their data, especially in China's situation. And look at this, the Chinese yuan currency has hit a record low against the dollar. And with their housing market collapsing, with Evergrande going down, well, China, I think, is fudging a lot of the data, because they're still doing lockdowns, but they're coming out saying our GDP is booming, retail sales is booming, our factory output's growing. It doesn't make sense at all, everyone, and I think they're cooking the books. But I don't know if you remember, in 2019, there was a repo crisis in the repo markets. That's where banks lent overnight, and what happened is interest rates spiked to 10% overnight for just a one-day loan, and there's fears that this could happen again. Repo fears. There are two broad categories of concern right now. Surging volatility in what are supposed to be the safest fixed income instruments in the world could disrupt the financial system's plumbing. Since treasuries are backed by the full faith and credit of the US government and are used as collateral in overnight funding markets, the decline in price and resulting high yields could gum up the smooth functioning of those markets. That's exactly right, everyone. And we saw what happened to the UK government when they tried to enact all these tax cuts and try to take on more and more debt. And I think it's only a matter of time before people say enough is enough with lending to the US government, because they're over $31 trillion in debt right now. And with interest rates rising, it is going to add trillions of dollars just in interest costs alone. Another warning, expect a tsunami. The second worry is the whipsawing markets will expose weak hands among asset managers, hedge funds, or other players who may have been over-leveraged or took unwise risks. While a blow-up could be contained, it's possible that margin calls and forced liquidations could further roil markets. And I don't know if you remember, do you remember Archegos, the hedge fund that collapsed in 2001 because they found out that they took a loan from one bank, they invested that, but what they then did was went and got a loan from another bank and then another bank and another bank. And if you think Archegos is the only hedge fund that did this in 2021, think again. I'm sure there's lots of hedge funds, just like what we saw in the UK with the pension funds leverage. I think we're going to see some margin calls for these big hedge funds, these institutions, and some of them are going to get wiped out, just like Archegos did. So-called zombie companies that have managed to stay afloat because of the low interest rate environment over the past 15 years will likely face a reckoning of defaults as they struggle to tap more expensive debt, according to Deutsche Bank strategist Tim Wessel. And so they should fail, everyone. This is not real capitalism. This is crony capitalism by letting these zombie companies continue to exist. And this is why equality is so out of control. Not because of capitalism, is because there's been socialism for these big, huge corporations. They've been continually getting bailed out. And so what they do is they take on more and more risk, knowing that the central banks will be there to save the day. When if we try to take those risks, we would go bankrupt and there'll be nobody to save us or small businesses. But the real risk they're warning is the unknown. The real worry is that you don't know where to look for these risks, only that they will come. That's one of the points of tightening financial conditions, is that people got overextended ultimately pay the price. So everyone, I know what you're thinking, okay, what does all this economic jargon, what do all these financial terms mean for you in simple terms? What this means, everyone, Credit Suisse is in big, big trouble, and we could see the beginning of the end right now. I'm not saying they're going to collapse this week, but we could see the beginning of the collapse start this week. But Credit Suisse is only the beginning, and as we see interest rates rise more and more, we're going to see more companies come forward to say they're in big, big trouble. And this is why I've warned you, don't want to have all your money in the bank, or at least not have all your money in one bank. You want to diversify, have some cash on hand, have some gold and silver in case of a full-on banking crisis. But everyone, what do you think about this? Let me know. Thanks for watching. I'll see you all in the next video.